Tuesday 11th price review. So getting started looking at the NASDAQ and the S&P. As you guys already know, in the previous live stream I stated that we wanted to see this 4-hour fair value gap act as an inversion fair value gap to support price higher, taking out this high for the NASDAQ and this high for the S&P. And there were equal highs on the NASDAQ that's somewhere back here, but you guys get the main point of we wanted to see higher prices. And while we did get a dip into this inversion fair value gap, which sent price higher in the morning session, which we will get into, it didn't really expand explosively, which we anticipated from the economic calendar. We expected today to be a little bit lackluster, and it's pretty much what we got in the morning session. It was a little bit difficult to navigate. So I still do believe that we can trade above this high, maybe even higher, for the CPI release. So I'm definitely still bullish. Now, don't take my word as the gospel or anything and try to trade ahead of CPI, because it's not the event that you want to be stuck in a trade whenever it releases because of the major volatility that comes with it. But gun to my head, I still do believe that this high on the NASDAQ and this high on the S&P is what price will want to draw towards upon that release. So looking at this diagram here, you guys remember this diagram. This was posted in the previous core content lecture. Now, we quite didn't have a clear key level, but something that was a hint was that 4-hour inversion fair value gap that I had outlined for you guys. And this is literally exactly what we saw today. So going from that 4-hour chart to the 15-minute chart, we had price in a bit of a consolidation, ran lower, and then reversed, seeking higher prices. Now, although there wasn't a sequential SMT right here, there still was a run under the previous quarter's low and then a reversal. So you don't always need sequential SMT. Now, does it add a lot of probability to a trade? Yes. Is it the foundation for narrative? Yes. But whenever you're on these intraday cycles, like the daily cycle, the 90-minute cycle, the micro cycle, once you have your narrative established, you don't necessarily need SMT. SMT just solidifies stop runs and tells you whenever stop runs are high probability. So this, for example, was a stop run on London's low and all three of the assets. And in that core content lecture, I said there were many things that could constitute a high probability setup, but all you need is two of them. So for this instance, we were trading inside of a key level, which is that 4-hour fair value gap that I outlined, but I don't really count that just because it wasn't very clear and price had already been trading inside of it. But shortly after we ran the stops of London session, under the true opening price for the daily cycle, we formed a TPD at 9:15, right before that 9:30 candle, inside of a new week opening gap on the S&P. So that's two things right there that could have constituted a high probability setup to allow for buys. And yes, even though the Dow is decoupled, once you get to the daily cycle and below, it still can be used for these lower time frame cycles. Not necessarily so much for higher time frame like the weekly cycle and above, but the Dow, you can still use it as a way to kind of tip its hand. So the TPD was with this candle right here. This was the 9:15 candle. And as you guys can see, this is the close of candle 1, open of candle 3. There was a divergence or cracking correlation in with there on top of a new week opening gap, and you can go back in your charts and look for yourself on the S&P. It was there. But looking a little bit closer, we're going to zoom into this price action with the TPD. You guys can see there was a reversion level. So as soon as 9:30 opened up, it dipped inside of that reversion level and then expanded higher, giving a really clean and nice run on price. And keep in mind, it was also under the 90-minute cycle true open as well. So as you guys can see, this setup repeats very frequently and very often. Reversion levels are really clean and really good once you truly understand them, and we will go deeper into them this Saturday. But the 9:30 candle was candle 3. We're just observing it through the lens of the 5-minute time frame. So we went from a 15-minute TPD to the 5-minute time frame to see our reversion level, and then this 9:30 opening price right here would be candle 3, the opening price of candle 3. Candle 3 opened, dipped back inside that reversion level, and then price expanded higher upon the open. But let's say you didn't catch that down here. You didn't catch the reversion level, price was unclear, that's fine. The very first model I ever taught you guys, which unless you were paying attention in some of those earlier videos, then you would have known, the highest signature for price is whenever you have a breaker and a fair value gap overlapping each other. And as you guys can see, that same setup formed where this would have been our breaker, price traded back inside of that with a fair value gap and then expanded higher. Now, as stated last night, today was expected to be low probability. So that's why the trade didn't really hold for too long. And you don't want to hold on to trades for too long, especially in these sort of conditions. And I'm surprised that it offered something as clean as it did in the morning session. So that's really something to keep note of and keep in mind on low probability days, is not to overstay your welcome. If you're able to take something out of the marketplace, take your 2Rs, take your 3Rs, whatever it is, get it and get out. But hopefully you found this one insightful. I will speak with you all in tomorrow's live stream.